Okay, well, we get started. Thank you everyone for joining us for our Energy Tax Incentives, How to Claim Significant Tax Relief on Your Energy Costs webinar session. My name is Sarah Glanville. I work for Leyton UK, and I'm delighted to be able to work really, really closely with the Scottish engineering team. I look after our membership relationship network, and so I work very closely with John, and I've had the pleasure of working closely with the team to get this webinar up and running. But I'm going to pass you over to John to kick the session off today, and then we'll pass back to the Leyton team to discuss energy tax exemptions and how they are suitable for businesses like yours. So thank you everyone for joining, and John, I'll let you take on from here.
Thank you, Sarah. So I'm John. I work with the team at Scottish Engineering, and thank you very much for joining us this morning. I think, as we all know, energy costs are a huge issue in our sector. In Scottish Engineering, we have a broad base of members, the length and breadth of Scotland, about 570 and growing, representing a wide variety of the engineering and manufacturing sectors. We're out and about talking to our member companies week in, week out about their issues, about their challenges, their opportunities, how we can support them. And as people will recognise in this webinar, there are some real challenges out there at the moment facing members: economic uncertainty, export rules, tariffs, national insurance increases, skills availability, the list goes on. But there's always one issue which comes up again and again, and that is the spiralling energy costs. British companies are paying the highest electricity prices anywhere in the developed world. The cost of power for industrial customers has jumped by 124% in just 5 years, and that's according to UK government's own figures, taking us to the very top of the international league table. And it's now about 50% more expensive than in Germany and France, and 4 times more expensive than in the US. And these figures are, of course, a huge concern, particularly for energy-intensive businesses, but also for any company whose energy bill is a material part of their cost base, which is most. In many cases, they are crippling domestic. We know companies who have moved overseas or reduced production output, etc., because of energy costs. There are no magic solutions to this for us, but we were really interested when Leyton, our member company Leyton, suggested running a webinar to make sure that companies are aware of the range of incentives, exemptions, compensation schemes, etc., that are available for business. Being aware of what is available, whether your business could be eligible, and whether you're getting access to these schemes could be vital in mitigating your energy bills. And on that brief introductory note, I'm now going to pass over to Zach.
Thanks, John. And thanks for setting the scene quite nicely, particularly when it comes to the cost of energy in the UK, which, as you point out, is very different to what it was 10 years ago, or certainly 15 years ago when I started in energy. Let me do a brief introduction myself, and I've got my colleague Dean here today. So first of all, myself, my name's Zach. I head up energy here at Leyton. My background is energy over the last 15 years. I come from an energy consultant background and then an energy supplier background. So I've spent a lot of time with large organizations, helping them procure their energy and buy energy at the right price at the right time, etc. And I've also worked with energy suppliers and worked at a number of energy suppliers, so Total Energies and Corona Energy, around supporting businesses be more efficient with their energy usage. And for the last coming up to 3 years now, I've been at Leyton, and at Leyton I've been helping businesses really understand what is available to them to reduce their energy bills, but particularly the non-commodity side of their energy bills, which I'll talk about shortly. And Dean, do you want to give yourself a quick introduction?
Yeah, very, very quick intro. I'm the sort of commercial lead on the energy side of Leyton. Been here for 4 years now, and I've helped a wide sort of breadth of companies take advantage of all these different incentives we're going to talk about today.
Fantastic. So to set the scene a bit, I'll repeat a bit about what John just said, which is the cost of energy is very different now to what it was 5 years ago. I started in energy about 15 years ago, and in general, the cost of energy would fluctuate, but those fluctuations tend to be fairly small. So if you bought energy at the right time, you might save a bit of money. If you bought it at the wrong time, you might lose a bit of money. But those actual costs themselves didn't necessarily move a drastic amount. We then suddenly saw energy prices spike 2000, 2001 for a number of different reasons. And some of those reasons were economic. Some of those reasons were around world politics. And some of those reasons were around the climate. What's interesting is none of those reasons for energy prices spiking have gone anywhere. They might not necessarily be headline news, but they've not gone anywhere. And that's why the cost of energy is still such an important piece certainly for engineering businesses such as yourselves. I think it's absolutely key, the cost of energy. The other thing with energy is the cost of energy is split essentially into two. You have commodity, the price of energy, and that's what spiked. And you have non-commodity. And non-commodity is made up of numerous different things. I won't go into all of them. But if we break them down and say a significant part of those are taxation of some form. And what's interesting is they're also rising. Maybe not with the spikes that we saw in the energy market due to conflicts in Ukraine and domestic political movement and the climate and all sorts of things, COVID, but they have steadily gone up quite consistently, actually, over probably the last 6-7 years. And that non-commodity side is a side that you can have a look at and see whether or not is an opportunity there for you to reduce your costs. And a lot of businesses don't, because they don't think about this. And certainly when it comes to procuring energy, and my old background, most energy consultants and probably energy suppliers are only really looking at the commodity side for businesses. The non-commodity side, these taxations and these opportunities to reduce the taxation is something a lot of people don't look at. So what we do at Leyton is that's what we look at. We're not an energy broker or consultant. What we don't do is we don't procure energy for businesses. What we do is look at the taxation, the real specific energy taxation. And in particular, what we're looking at is we look at some of the schemes that are available for businesses to apply for one of two things, either an exemption to some of those taxation, so reduce your bill, or actually there are some schemes out there that offer compensation. So the government offers compensation back to you to help you with the cost of your energy bills. And they're schemes that aren't necessarily advertised. They're not out there. People aren't telling everybody about these things, but they do exist. And certainly myself and Dean talk to businesses every day who were either not aware that they could be exempt from some of these costs or weren't necessarily aware of how to go about it. And that's what we're going to talk about today. So 2 real schemes we'll probably touch on. I might talk about 1 or 2 others, but there's 2 really, really key schemes to talk about. One of them is the EII exemption scheme, so energy intensive industries exemption scheme, something that I would guess a lot of you guys on the call today may well be or should be having a look at. And the UK ETS compensation scheme. So they're 2 different schemes, one of them exemption, one of them compensation. That's all we're going to talk about today, and maybe touch on 1 or 2 other things. So as myself and Dean have a conversation, feel free to drop some questions in there. If you've got any, feel free to ask us. We'll pick up any questions at the end, and we're definitely here to help. So let's talk about, first of all, EII exemption. And I think probably I will, Dean's the expert on this area, so I'll probably pass to Dean in terms of maybe give that kind of brief explanation. So maybe Dean, do you want to start off by giving us a bit of an overview of what the EII exemption scheme is?
Yeah, of course. So the EII exemption, or it stands for Energy Intensive Industries Exemption, is an exemption from 4 of the sort of taxes or levies imposed on your electricity supply. So if you look at a bill and it's a nice itemized bill, you might see renewable obligations, contracts for difference, feed-in tariff, and recently they added in capacity market charges to the exemption. And if you're a business that's doing the right manufacturing activity, which I believe a lot of you in Scottish engineering would be, and you can demonstrate that you are an intensive user of electricity against some of your financial metrics, then you can essentially apply for a certificate from the Department for Business and Trade that deems you EII exempt. And once you've got that certificate goes off to your supplier, and some suppliers treat it differently, but typically what they'll do is if you get 100% exemption, you will get those line items zeroed on your bill. Sometimes you might not get 100% exemption, and that's typical and fair. You might be manufacturing two products, for example, only one's eligible and one is not, so you might get a 50% exemption, so on and so forth. But it's a great exemption that was really introduced to help UK businesses to keep their manufacturing activity in the UK. What they coin that as, I think, is carbon leakage. So it's to prevent carbon leakage, moving abroad where it might be cheaper to manufacture. And removing those four taxes can make a considerable dent in your electricity bill.
Okay, I think my there's a lot of, certainly within the energy industry, there's probably a lot of talk around the UK's energy strategy, or the government's energy strategy. I mentioned before spiking energy prices. I think one of the challenges that has been there has been, certainly from a domestic point of view, we've obviously had a fairly fluctuating political climate. I won't get into politics, but there's fluctuating political outlook in the UK for the last 4 or 5 years, and a number of prime ministers and changes of government. And of course, we had another change of government last year. There's certainly a lot of talk about what the current energy policy is. I think one challenge that the government has is balancing the requirement to go down a more sustainable route when it comes to energy supply, but also the costs. And this is the constant challenge that I think governments have had over the last few years is, on one hand, the absolute general cost right now of your energy bill, certainly engineering businesses, large organizations, energy intensive businesses, but also that requirement to be sustainable. And I think this is an example actually of whereby the government's got a lever that they can pull to support certain industries and certain sectors. So my feeling will be, and this is more of a personal feeling, but my feeling will be, one tactic the current government may use over the next 3-4 years to help reduce energy bills for organisations such as engineering businesses is schemes such as this, because what it allows them to do is continue to generate income for sustainable schemes, whilst also supporting large organisations or energy intensive organisations in reducing their bills. So I think this is it's an interesting scheme. It's a scheme I think potentially could roll out or be extended. I think, is that the case, Dean? So there's network charges, I think, as well, the network charges compensation scheme. Is that linked to the EII exemption scheme?
Yeah, so recently they extended the EII exemption to include a network charges compensation. So what does that mean? If you have an EII certificate, you can get compensation to offset up to 60% of your network charges. And sometimes those network charges can be massive because of where a business is located, how much infrastructure there is to actually get the energy to the site, etc., etc. So they rolled that out most recently, and there's an instance where businesses who, for example, are not actually paying some of the EII taxes may benefit from having an EII certificate solely to get the network charges compensation. And it leads into quite a good point, Zach, of with the government introducing a number of new sort of taxes and levies to pay for all of their additional sort of incentives, so like new nuclear, new carbon capture, etc., with them introducing them, we think it would be quite an easy path for them to follow to mirror what they've done already, aka get an EII certificate, because when they roll out all these other things, you're more than likely going to have that to take advantage of the exemptions or the compensations that come alongside it.
Yeah, it's interesting if you think about it from a procedural process point of view, as far as the government's concerned. If they can have one process to check eligibility, any new scheme they roll out, they can roll out a lot quicker rather than having multiple different claim processes. And actually, network compensation scheme, the network charges, just to touch on what Dean was saying, network charges are essentially a cost that's charged for getting the electricity or the energy to your site. So the further away you are from a major network hub, the larger your network charges are. So your network charges aren't necessarily, if you use a lot of energy, doesn't necessarily mean you have really, really high network charges. However, equally, you could be using quite not that much electricity, but actually your network charges could be really, really high. So as Dean says, it's worthwhile looking to get an EII exemption certificate, because that opens the door to other potential opportunities, network charges being one that exists today. But there's 2 or 3 other schemes, there's 2 or 3 other new taxes expected to be added to bills in the next 2 years. There's certainly a nuclear tax expected to come in. And my view is that I think from a government point of view, continually adding to taxes at some stage is going to have a real impact for them, because there's a need to reduce costs as well. And I think one lever they may have is to say, well, look, we're going to add all these taxes across the board, but actually you guys here, energy intensive industries or industries we absolutely categorically want to support, if we are going to have growth in the UK, we need engineering, we need manufacturing. If we're going to support these organisations, one lever we have that we can pull fairly quickly is to say, well, here you've got this lovely piece of work whereby we've added these taxes, but also we've pulled this lever and we've given you guys support, so actually you guys don't need to pay it, and we can do it really, really quickly. If you already hold an EII certificate, you kind of get the key to the golden essentially get the golden ticket, and you're able to kind of get the exemptions straight away from those other products. So it's a real key point. So when it comes to EII exemption, then, Dean, from your point of view, what kind of industries or businesses do you typically find are likely to be eligible for the scheme, or at least what kind of industries and sectors and maybe activities do you think should absolutely be looking to see whether they're eligible, or at least reviewing this?
I suppose the really high level, anyone working with metal, anyone working with chemicals, anyone working within the sort of paper and packaging sector, plastic packaging as well would be very good. So it's quite broad. What's the hardest hurdle here, and to frame that, there's only about 330 companies in the UK currently claiming an EII exemption. So it's a pretty darn exclusive club to be part of, right? The main barrier to entry is determining if you're intensive enough against your financial metrics. So lots of companies are doing the right things, where the typical pitfall is actually overcoming the intensity test. They call it the 20% test. And that's where we need to take some of the financials of the business, like EBITDA, wages, etc., and we need to showcase that 20% of your what they call gross value add is equates to your energy costs or your electricity costs. So apologies for that too much info there, but essentially that's the main barrier to entry. Now, why over the last couple of years have things enabled more businesses to take advantage? Well, every year in April, which just happened, the calculation changes slightly. So some of the numbers we use in the background to calculate change slightly. And over the last couple of years, those numbers have been more favorable than they ever have. So a lot of companies might have heard of this, 3, 4, 5 years ago, looked at it, never qualified. But now that the numbers in the background are more favorable, and that's simply due to high energy costs, it may be the case that they can now meet that 20% test.
Okay, and I think I'm also right in saying that the other area to look at is businesses who may look at sectors or industries and go, well, I'm not in that sector, I'm not in that industry, but the eligibility is based on what they do, isn't it, rather than necessarily the sector they're in. So as long as you're carrying out one of the activities that's eligible. So that's the one thing we would always say to businesses. And it is an exclusive club, but we're literally constantly talking to businesses who are eligible and may have either tried before and not been successful, or not quite understood it, and go, well, actually, I'm not a energy intensive industry, or I'm not a manufacturer, therefore I'm not eligible. And actually what we're saying is, depends what you do, depends what your activity is, and you may well find there's one piece of activity in your process that is eligible. So I think from an eligibility
I was just going to say it.
Yeah, go on.
Sorry, Zach.
That's right.
It's just one of the most common pitfalls is I find that companies will look at the list of eligible sort of manufacturing sectors, and they'll look at something like their company's house and say our SIC code's not on the list. And that's because the SIC code maybe isn't the true reflection of what activity's happening within the business. You know, that SIC code a lot of the times actually put there by an accountant who created the legal entity years and years ago. So a lot of companies rule themselves out straight away, but it's more about, you know, pulling apart what does that company do from start to finish? Is there eligible manufacturing activity happening along that journey? And sometimes what we'll find is, you know, there's a pocket of eligible manufacturing right bang in the middle. So it's not at the start, it's not at the end. It's not the end product that's all over their website and is what they sell as such. It's the middle part that's eligible. And what we can then do is get an exemption from the energy consumed in that middle part. That's where you would then get a, you know, say a 30, 40, 50% exemption certificate.
Dean regularly surprises me by coming to me with clients who I look at and go, oh, why would they be eligible? Because you take one look at them as an organisation and go, well, they're clearly not going to be eligible. And actually, as Dean says, what he's done is he's pulled apart their entire process and gone, but this part here is this part right in the middle of what they do. And Dean always surprises me by coming to me with clients that I genuinely didn't expect or would not have thought of, as to say, actually, these guys are really, they clearly can claim this. So that's why I think when I said at the start, one of the key things for me, one probably takeaway, if I was giving advice to any, certainly engineering business, I would be saying is just get it reviewed. Just every year, once a year, do a review of what you do a review of the criteria, do a review of your numbers, and then worst case scenario, look, you're not going to be eligible for an exemption, but you can sleep easy knowing you've done everything you can to reduce that bill. That's my advice to any business, is just on a yearly basis, review it, have a look at it, and, you know, let's see whether there's an opportunity there. If there isn't, there isn't. But if there is, you could be looking at significant opportunity to reduce your energy bill, not just by the exemption itself, but by all of the other opportunities that, you know, are linked to this exemption. So that value could really, really increase. And, you know, goes back to what both myself and John both said at the start, is cost of energy is certainly not going anywhere. It's not going to be reducing massively anytime soon. So it's going to be a big factor for you. Okay, so EI exemption. So how does it work then, Dean, in terms of, so what actually physically happens then for a client? How do they get the benefit? What is the benefit?
Well, basically, we would need to determine eligibility. We would then put in what we just call an EII submission into the Department for Business and Trade, and there's quite a small team within DBT that we're familiar with that manage all of these exemptions. And it can take a wee while, you know, from that submission goes in. We've been promised, you know, a turnaround time, I think, of about 8 weeks. Sometimes it's longer, sometimes it's quicker, though, I suppose. But once that's in and once it's approved, you know, and the government's approved it, you will get a certificate. That certificate is then valid for 5 years as long as it's maintained. And there's a bit of quarterly and then annual admin required to maintain it for that 5 years. But once you have the certificate, you don't need to prove your eligibility again. You need to just maintain it, you know, through that sort of admin again. We do that here typically. That certificate goes off to the supplier, and the supplier should zero those line items on your bill. What's it worth? An EII exemption is typically worth around a reduction of about 5p per kilowatt hour. So depending on how good your deal is, that can be a pretty hefty chunk of the overall bill, and that's not even including the network charges compensation on top of it.
And I mean, 5p, and again, it's really interesting. I often talk to my background being more energy consultancy around procurement. 5p kilowatt hour is a significant value. It really is significant value off your bill. And as Dean says, not including the other sides to it. The other challenge for any business, though, just to be aware in terms of challenges and some of the things that are difficult with this, would be the certificate then allows your energy supplier to reduce those costs. I've worked for 2 energy suppliers. I've been in the industry 15 years. I've always been a believer that the energy supply industry is, from a service point of view, not one of the best we have. It's something we shouldn't be particularly proud of. We've not necessarily invested in a great deal when it comes to energy suppliers. That is one of the challenging parts of it. First step is get your certificate. Second step is get your supplier to then amend your bill so you're getting those exemptions. That's a really tricky part. Not particularly easy thing to do, but again, it's something that we do here at Leyton. We really push suppliers to do it, and there's a lot of talk in the industry trying to get suppliers to be better at that. But it is one of the challenges. The admin, I have to be honest with this. The admin is one of the hardest parts of this whole scheme. Working with the Department of Business Trade and working with energy suppliers, but the benefits are huge. So great. So I said we'd talk about 2 different products. So let's look at product number 2. So the UK ETS compensation scheme. So slightly different scheme, has similarities, but it's slightly different. So Dean, what would you say is the difference between the UK ETS compensation scheme and the EII exemption scheme?
Well, the first one is that it's a compensation, so you're getting paid cash. So rather than reducing the bill, you're being paid cash. What's that cash actually for? It's to reduce the indirect impact of the UK's emissions trading scheme. So basically what the government are saying is, because of the existence of the UK's emissions trading scheme, there's an indirect impact on electricity prices, aka it's a bit higher. So what they'll do, if you're in the right sectors, and again, if you meet the right sort of intensities, and it's a different test, but if you meet the right intensities, you will get basically a letter that says, for the next 12 months, you have been awarded X amount of compensation, and we'll pay it over these 4 quarters. So it's a cash payment. Some businesses prefer that, because they can spend whatever they want. But it's a cash payment, and that's really the main difference. Eligibility, the test is slightly different. I would say that the way the test works is, on paper, it's harder to meet that intensity test. However, the ETS compensation scheme has less strict guidelines about the financials that are included. There's rules that allow us to, just ring fence, for example, part of your manufacturing process. So rather than take the financials for the whole company, we could just ring fence the eligible part and apply using those numbers instead. So it can be easier to meet it if we look at it from that angle.
I think I always find the compensation scheme seems to be more popular with clients, and I think that's because of that cash payment, which always psychologically, I think always receiving cash feels better than having a discount off something. The reality is, I actually think there's probably more value in the exemption scheme than the compensation scheme, but interestingly enough, I think there's that psychological piece of getting that transfer. I think maybe to give you a bit of an overview of why the scheme exists, really similar to actually EIA exemption, in terms of it's a lever for the government to support businesses in reducing their energy and to cover the indirect costs. But one reason the scheme does exist is to actually say to businesses, or actually one other thing you can do is reduce your energy costs. So the best way, the 2 things you should be looking at as a business who's got high energy costs is, 1, using less energy, or 2, generating your own energy. We won't talk about that today, but although that is something Leyton do support businesses with. But if we look at reducing your energy, as I say, through taxation, this is one of them. It's a really good opportunity to do that. But what this scheme is set up to do is to help support businesses by offering compensation, which can then maybe be fed back into the business to support energy reduction technology or schemes or ways of working. I always believe that rather than take advantage, so this is a great scheme to take advantage of the data you need to collect to be eligible. You need to collect a lot of data on your organization. You need to understand how your organization works. You need to understand how your processes work to be able to see whether you're eligible for it. Take advantage of that process by actually giving you an opportunity to review that process, review your financials and think to yourself, actually, are there any other ways I could reduce energy rather than just taxation? Because this is a good opportunity to review all of that and say, well, actually, we've got a compensation scheme here, but actually we could invest that compensation scheme into our business and look at maybe some energy reduction technology, which might actually help us even further in the long run. So it's an interesting scheme. As Dean says, it offers compensation rather than exemption. So I talked earlier about how sometimes one of the challenges with the EI exemption is getting the energy supplier to do what they should do, which is reduce your bill. Actually, this isn't the case. This is a direct payment from the government. So essentially, if you're eligible, the government will pay you a compensation amount quarterly. You'll get a 12-month letter that says every quarter we will pay you this money, and you get that money. And then every 12 months you have to do an annual return to look at the next year's value. And then that will be paid to you, obviously based on your consumption and stuff like that. So I find this scheme a tiny bit more straightforward in terms of understanding than the exemption scheme. Other thing that Dean touched on there that I would have to say is really, really important is I've worked in energy for a long time, but for 3 years I've been at Leyton, particularly focusing on the taxation side of energy. One really interesting thing is working with any of these government schemes is you understand very early on is there is no actual clarity in the guidelines. The guidelines will quite often be fairly vague. One thing to understand is challenging those guidelines and really understanding what the meaning is around them is something that we do a lot of. And because we have the experience of working with lots of different businesses, it gives us the opportunity to understand actually this works and this doesn't work. One thing, again, I'd say to any business is never take the guidance literally when it comes to any government guidance, because it tends to be fairly ambiguous and can be read in a number of different ways. Right now, all the time, we're constantly coming across lines within the guidance that we clarify, and we've had quite a lot of the guidance amended due to our actions when we've challenged DBT on it, and they've gone, actually, yeah, that's not quite clear. So the other thing I would say to any business is don't necessarily think you're ineligible and always will be ineligible. I think it's a matter of it's an absolute moving part. So make sure you're regularly checking whether or not that eligibility changed and actually whether it might work in your favour. So on the UK ETS scheme, what would you say? So again, what are the benefits of it in terms of what kind of financial benefit could you look at? Is it the same as EI exemption in terms of a pence per kilowatt hour? What kind of savings or compensation can businesses potentially get from this scheme?
As a sort of general guide, I would say it's around 2 pence per kilowatt hour would be the rate of compensation you'd receive. So it is a bit less than the EII exemption. Again, what's quite good is both of these can run in tandem, so you can have both of them. So team them up, and you've got 7p discount essentially. But there are scenarios sometimes where the financials of the company sit in the right space where they actually get paid a lot more than that. Some sectors, some manufacturing activity has been deemed as having more risk of carbon leakage, because again, this is what all of these incentives are about, keeping the engineering or the manufacturing in the UK. So some activity has been deemed as more at risk, and they've actually got a higher rate of relief automatically assigned to it. So again, there's quite a lot of nuances to determine if you would get that higher rate of relief. But when you do, it can pay real major dividends. I've seen companies get compensated, and it's covered more than half of their annual bill, for example.
Yeah, It just goes back to what we were saying before. Just think of it from the point of view of why these schemes are in place. They're levers to be pulled to support industries, and right now, particularly from where we're at is the push to incentivize growth. This is a really easy way for the government to go, actually, we can really financially support industries and sectors that we want to. We can do that very, very easily through these schemes that already exist, without having to necessarily, create something new or go through a whole new process. And that's why my personal opinion would be, I think over the next 2 to 3 years, you will find that schemes such as this will be extended rather than a whole new way of working. They'll be extended because they work, they're quite smart, the process is in place already. So I would again strongly suggest that businesses are thinking about, could they take advantage of this, because it's a really good scheme. And the compensation scheme generally is, as I say, a tiny bit more straightforward because you don't have that challenge of an energy supplier at the end of it. You receive direct payment from the government, which is great. And let's be fair, there's not a great deal of schemes out there where you receive direct payment from the government. So let's celebrate when they do exist and take advantage when we can. Very briefly, I'm going to touch upon one or two other things that exist. As I said, they're the two main ones I think that would work for you guys. There are other schemes. There's the climate change levy scheme, where you can get a reduction on your climate change levy, which goes into your bill. You can either do that directly or via a climate change agreement. So there's schemes there. So again, worth looking at, worth understanding. And I think outside of that, it's worth noting that there's probably 2 or 3 potential new schemes that are due to be added. I touched earlier on a nuclear tax that I believe is likely to hit in the next 2 years or so. I think there's a move towards more nuclear power being generated in the UK. Great way of doing this or funding it essentially is via taxation of energy bills. Again, like I said before, my firm belief will be it will get added and there will be exemptions and compensations available for businesses, certainly in the engineering sector, to be able to take advantage of actually reducing those. But look, in the first instance, it's going to come on your bill, and the first instance, it's going to hit you, and those extended costs are going to be really, really challenging for businesses. So worth keeping those in mind. I suppose one question I've got, maybe Dean, that you could maybe answer is regarding the ETS and the II exemption schemes. What common misconceptions do you find when speaking to businesses about these that you can maybe address?
Yeah, it's some of the stuff we've already touched on, I suppose. The main one being a belief that because their SIC code doesn't marry up with some of the SIC codes that are on the guidance, that they are not eligible, and it's not really about what your SIC code is in Companies House. It's about what manufacturing activity you're doing. So I would look at it from that angle rather than just sort of on paper Companies House side. The second one is that because they say, energy intensive industries, etc., that businesses automatically deem themselves not intensive enough without actually crunching the numbers and determining that, that there's a really, really big downfall. A lot of businesses, what they look at is how much they're spending, and what we're actually looking for is how many kilowatt hours they're consuming, and using that number against some of their financial metrics, which spits it out. Because it's not really about how much you spend, it's about how much you consume. And that, I suppose, is the key too that I see time and time again. Just an automatic sort of a look at the guidance at a very high level and the determination, all right, we don't qualify, or that's not for us. And that's a lot of the time, that's the sort of people I'm speaking to, and then showcasing, right, this is where you have eligibility, this is how we meet that intensity test.
Okay. I mean, from my point of view, what I would say is, look, energy costs are high. They're a big impact in a business, particularly engineering, but just actually any business across the UK, energy prices are a big chunk of what you do. And I think sometimes there's a feeling of it can't be controlled. I think that feeling, certainly over the last 4 or 5 years, is when I speak to clients, there's a feeling of what can we do? Energy prices have spiked, and we can't do anything about that. Well, the truth is, you can't do anything about spiking commodity costs. You can't. Rising conflicts in Ukraine and between Ukraine and Russia. There is nothing that we can control, but we can control the non-commodity side. There is some control there, and I suppose what I would say to a business is try and control what you can, focus on the bits you can, and make sure that you are as prepared as possible if we do see a rise in energy prices again. As I mentioned before, the factors that made energy prices rise, they may not be headline news as they were, but they haven't gone anywhere. They still exist. Those problems are still there, and they could spike again. If they do, make sure you're prepared as you can be. You can't control that, but you can control non-commodity costs to an extent. So you can make sure that you are not paying a penny more than you should do. And if there are exemptions out there, you're taking advantage of those exemptions. I think then on top of that, there's also an argument to say, generally within energy, take the time and maybe regularly be looking at your entire business from start to finish. Where is your energy being consumed? How is it being consumed? And are we being as effective and as efficient as possible? That's a piece of work that can be done. It's not overly complicated. And you could find that the savings are there, or there are savings there. But even if they're not, you're sat there going, well, actually, I've done that piece of work, and I'm really sure that as well as I can be, we're as efficient as we can be. It's going to be difficult for any organisation to be absolutely perfectly efficient. But look, if there's ways to improve efficiency, and my other point would probably do it all in one go, because a lot of the time what you'll end up doing for a scheme like this, you'll be collecting loads of data of different parts of your business to make a claim. Actually, that data could have helped you put together a bigger plan. So my suggestion for businesses categorically would be, on a yearly basis, make sure you are reviewing the non-commodity costs within your energy bill every single year. Review it. You may be eligible, you may not, but you've reviewed it, and I think it should be a piece of work everyone does, and it's not overly complicated once you know how you're doing it. And of course, we can always help that at Leyton as well. So I think from my point of view, I think we've covered the areas we wanted to today. I don't know, Dean, have you got anything else you wanted to add that you think we've not covered?
Well, just to touch on when you mentioned there about review on an annual basis. The schemes are updated every April. So if you don't qualify, once April rolls round again, usually takes the government a couple of weeks to put it out officially, but that's when they will have upgraded the sort of numbers in the background for these intensity tests that you need to meet. So April's actually a good time to look at it, and just maybe just stick that sort of in the diary. Yeah,
and I think so. I think John asked a quick question around key eligibility for EII certificate. I look at it probably a bit more straightforward, and I less in the detail. There's two parts to it, and one's a financial test, and one's what you do. So what I always say to clients is the key criteria is in first to look at is, what do you do? Do you do one of the activities that's eligible? And I think Dean's mentioned a couple of times, and he's absolutely right. Don't think SIC code, don't think sector, don't think industry. Nice guide. If you're in these sectors, you definitely should be looking. So I really mentioned metals and chemicals and packaging before, absolutely categorically. If you are in those sectors, absolutely be looking at this. But actually, even if you're not, it's worth understanding the activities. So it's an activity-based eligibility criteria, not necessarily your sector or industry or SIC code. And I think what we've definitely found is we found businesses who, as I said, when I say we, it's the royal we. Dean's the best guy doing this rather than myself. But I said before, Dean's come to me before with all sorts of weird and wonderful businesses that you would not have thought at all would be eligible, but actually were eligible because of these activities here. So first of all, activities. Second is the financial test, which Dean touched upon before, which we call the 20% test, which is all around actually how intensive you are. So they're the two main criteria. Dean, would you add anything there?
No, I think that's pretty much it. We want to understand from start to finish manufacturing. Once we've then pinpointed eligibility within that, that's when we can then look at right, let's crunch the numbers and determine, can we meet that test?
Yeah,
That's
fantastic. And also worth noting, and I won't, this isn't something I'll ever go into detail on. I mentioned before around the criteria. There are weird and wonderful things you can do within those financial tests. There are bits you can leave out, bits you can add. All of this is in the guidance, but is detailed in lots of different ways. So you can sometimes pick and choose the data you use to come to that number. So again, don't we've had clients in the past who've been really clear we're not eligible because of financial point of view. When we've run the numbers, we have found they are eligible because there's different ways of going about it. So keep that in mind as well. We haven't got any other questions at the moment here. I don't know if anyone else has a question to ask. Oh, Sarah, I can't quite. I don't know if you're on mute, Sarah.
Sorry. Yeah. We do have a couple of questions in the Q&A box. So Lisa Mosman wanted to know: is there a link to the applications, and is this something that Leyton can support with?
Oh, Dean, do you want to answer that?
Yeah. Well, yeah. So the Leyton, this is what me and Jack and the team of consultants that sit behind us spend all our time doing. So we can definitely support you with that. The applications, there's I suppose we can try and find the websites, but if you were to Google, that's probably the easiest, and look for the Gov website. Sometimes it's not the easiest thing to find, but yeah, you can definitely find links to the applications. But Leyton can support you as well and help you navigate it.
I would say, Lisa, though, the main thing that Leyton can support you with, there's 3 key areas. One is making sure you are eligible, and taking our knowledge and expertise that we've done this so many times that we get it. But outside of that is, first of all, is getting your certificate. We haven't really touched on it. The Department of Business and Trade, when you make your application, they're the people who review it. They can be very, very detailed. They can come back with multiple questions. Some cases they don't, some cases they do. Some cases they'll come back with huge amount of questions, huge amount of extra data they'll require. In some cases it may be fairly quick, in some cases it may be fairly slow. It's worth saying that as a government department, they have had challenges over the last 12, 18 months, particularly around resource, which is great that they're now cleared up now. We're finding they're a lot better, but that relationship we can help with by just managing that process. And I touched on it before with the II exemption, is certainly it would be dealing with your energy supplier, because anyone who's ever had to pick up the phone to an energy supplier will know that's not fun. Thankfully, not something I do that much these days, but we have a team of people who do it, and I wouldn't wish that upon anyone. So we help with that as well. So yes, we can help. I think, Stuart, you've asked, can you qualify both the EI and ETS schemes, or is it an either or qualification? Straightforward answer: yes, you can, absolutely, categorically. And we have multiple clients who are eligible for both. The criteria is literally separate, so they're seen as separate things. It's the same organisation who reviews it, though. So again, Department of Business and Trade are the organisation in question. So it's the same people who review them. Categorically, you can apply for both. So yes, that's a fairly straightforward one. What would the cost for us if Leyton assists with the application? That's probably your area, Dean. Do you want to?
Yeah, we work on a contingency fee basis, so it'd be a percentage of the benefit you receive. So a lot of the work we do is upfront, making sure that there is going to be a benefit for both parties. But the sort of fee percentage would be dictated by the opportunity size. So it's not a one size fits all, but it is very much a percentage of the benefit you would receive.
One of the reasons we do that is it goes back to the eligibility again. From our point of view, is we wouldn't want to be charging you for us to check the eligibility and ensure it's eligible. As far as we're concerned, you will only really pay once the eligibility is confirmed and you've received some benefit. So it's kind of a benefit-based system. If you think about the compensation scheme, the way our schemes tend to work is we'll take a percentage of that, but we'll actually only take it even then after you've received the payment from the government. So the government will pay you, and then we will invoice you a percentage of that. So again, from your point of view, it's a nice scheme. Actually, it works really well for us as well, but it's a nice scheme for you in terms of that opportunity to get involved in these things. So and certainly we're more than happy to talk to clients and have that conversation with anyone and give advice on it. So feel free to give us a call, book a meeting, or do whatever you need to do to have a chat with us, and we're happy to have that review. Dean's always happy to chat to clients, so feel free to reach out to Dean or any of the team. I'm sure the rest of the team would like to talk to you as well, but in particular Dean. Have we got any other questions coming through? I don't think we have at the moment. Have we, Sarah? No? Good. Well, I suppose from my point of view, first of all, thanks, Dean. I appreciate your time and taking us through that. I think from my point of view, final piece would be a call to action for anyone. If you're not sure, just pick up the phone to us and we'll help take you through it. And worst case scenario, you can sit back and go, well, we're not eligible, but we definitely looked at it. Best case scenario, there could be some real financial benefit you're sat waiting for that could be out there right now. So maybe think along that. I don't know, John, do you have anything you want to add before we finish?
I just want to thank you all for taking the time to come on and explain these points in the process. I just reflecting on a point you made. I have heard member companies saying, yeah, none of these schemes would apply to us. We're not energy intensive. We're not a steelworks. We're not a chemical processing plant. And I think the key lesson that I heard today was energy costs have increased dramatically as a percentage of your profit margins, turnovers, whatever. The rules themselves change, and it makes a hell of a lot of sense to check in regularly. Because and the SIC codes as well. It makes a lot of sense to go beyond these high-level perceptions of who's eligible and who isn't, and to check it out either as a company or with the support of yourselves. And I think that's great advice for all companies in the sector.
Fantastic. Good. Well, thanks everybody who's attended. I hope you've taken something away from it, and you've kind of enjoyed the session. Appreciate your time, Dean, and thanks for inviting us, John. So we will end the session there. Thank you.
Thank you.
Thanks, everyone.
Thank you.
Hi, everybody's away.